Have you ever, opened up a company's financial report and just felt overwhelmed,
Yeah.
trying to figure out the real story hidden in all that jargon?
Absolutely. It's like trying to find a needle in a haystack sometimes.
Right. Well, that's what we're here for today. We're going to do a deep dive into the latest results from InterGlobe Aviation Ltd. You probably know them better as IndiGo.
Exactly. We're looking at their Q1 results for fiscal year 2026, the quarter ending June 30th, 2025.
And our mission, for you listening, is really to cut through all that complexity. We'll pull out the key insights, maybe some surprising facts from IndiGo's own financial statements, their press release, the investor presentation.
All fresh off the press, approved by their board on July 30th, 2025. So these docs give us a really good inside look at how they're doing and where they might be heading.
Okay, so let's jump right in. What are the big headline numbers telling us for this quarter?
Well, the first number that jumps out is the net profit. They reported INR 21,763 million.
21, almost 22 billion rupees. That sounds pretty healthy on the surface.
It is a solid number, definitely, but, and this is important, it's actually down compared to last year.
Oh, really? By how much?
It's a 20.2% decrease from Q1 of fiscal year 25. Back then, they made INR 27,288 million.
Okay, so a noticeable drop in profit. Did their revenue also drop?
See, that's the interesting part. No, their revenue from operations actually went up by 4.7% year over year, reaching INR 204,963 million.
So wait, more money coming in the door, but less profit at the end of the day. That's counterintuitive.
It definitely points to some pressures, right? Either costs are up significantly, or maybe they couldn't charge as much per ticket, or some combination. We'll need to dig into that.
Right. What about EBITDA? That's usually a key metric for airlines, isn't it? How did that look?
Good question. EBITDA, that's earnings before interest, taxes, depreciation, amortization, and rent costs, came in at INR 57,386 million.
And compared to last year?
Slightly down, a decrease of 1.2%. And consequently, their EBITDA margin also dipped a bit.
From what to what?
It went from 29.7% last year down to 28.0% this quarter.
Okay, so that confirms the trend. Even before getting to the final net profit, their core operational earnings power relative to revenue softened a bit.
Exactly. It makes you wonder, are they growing efficiently, or is the market just getting tougher?
How did IndiGo's leadership explain these results? Did the CEO, Mr. Elbers, address this?
He did. He pointed to, and I'm quoting loosely here, significant external challenges that created headwinds for the whole aviation sector in the June quarter.
Okay, so acknowledging industry-wide issues.
Yes. But he also stressed that despite these challenges, IndiGo still managed a net profit with an 11% margin. He framed it as a sign of resilience.
An 11% net margin is still quite decent in the airline world, especially if things were tough sector-wide. Was he still optimistic?
Oh, definitely. He talked about IndiGo's scale, their network, the fleet, basically saying they're well positioned for future growth as air travel continues to pick up in India.
Okay, that makes sense. Let's shift from the financials to the actual operations then. Flying planes, filling seats, how they do on passenger numbers.
Strong growth there. They carried 31.0 million passengers.
Wow, 31 million in just one quarter. How does that compare?
That's an 11.6% increase compared to the same quarter last year, so definitely more people flying IndiGo.
And did they add more flights or bigger planes to handle that? What about capacity?
They did increase capacity significantly, measured in ASK's available seat kilometers capacity went up by 16.4%.
Okay, hold on. Capacity up 16.4%, but passenger numbers up only 11.6%.
You got it.
So that means their planes weren't quite as full on average, right? What happened to the load factor?
Spot on. The passenger load factor, or PLF, was 84.6%.
84.6. That's still pretty full, isn't it?
It is, objectively, but it's a drop of 2.1 percentage point from last year's 86.7%.
Right. So flying more seats, but a slightly lower percentage of them filled. Ties back into that revenue pressure we talked about earlier, maybe.
It certainly seems connected to that idea of a moderated revenue environment the CEO mentioned.
Makes sense. And what about where they're flying, their network?
It's huge. As of June 30th, 91 domestic destinations and 41 international ones on their own schedule.
That's a lot of routes.
Yeah, and they were running a peak of 2,269 daily flights during the quarter. Plus, through partnerships, they offer service to another 62 international spots, so their reach is pretty extensive.
And the planes doing all this flying, what's the fleet look like?
Total fleet size stood at 416 aircraft.
Right.
It's a real mix. You've got the older A320 CEOs, lots of A320neos, the bigger A321neos, some ATR turboprops for regional routes, 3 A321 freighters for cargo.
Freighters, too. Interesting.
Yeah, and they also use damp leases, like some Boeing 777s, 737s, even a 787 Dreamliner.
But the report also mentioned a decrease in passenger aircraft
Right.
by 18 planes.
Yes, that was a notable point. A net decrease of 18 passenger aircraft during the quarter.
Why would they shrink the fleet if they're growing capacity overall? Seems odd.
It does seem a bit counterintuitive. It could be returning older leased planes, maybe grounding some for maintenance, or Pratt& Whitney engine issues, which have been a factor, or just optimizing the mix. It suggests they're actively managing their assets, not just adding planes indefinitely.
Okay. And despite maybe juggling the fleet, how do they do on operational stuff like being on time, reliability?
Pretty solid, actually. Technical dispatch reliability, basically, planes being ready to fly without mechanical issues, was 99.88% between April and June.
That's impressive.
Yeah. On-time performance at the 6 major metro airports was 83.4%, and their flight cancellation rate was low, just 1.0%.
So the planes they were flying were generally reliable and on schedule. Good to know. Let's connect this back to the money side again, the economics. How much were they making per passenger, per seat?
Okay, so yield, that's passenger ticket revenue per kilometer flown by a paying passenger, that decreased by 5.0%. It came down to INR 4.98.
Less money per passenger kilometer.
Okay.
And RASK revenue per available seat kilometer.
That's on even bigger drop. RASK decreased by 10.0% to INR 4.86.
Wow, 10%. So even though they added capacity, the revenue generated per unit of that capacity fell quite sharply.
Exactly. It really underlines that revenue environment moderation point. Seems like filling those extra seats might have required lower fares, or maybe the market just wasn't as strong overall. It points towards a pretty competitive environment.
Makes sense. If revenue per unit is down, you'd hope they manage costs well. What's the cost story?
It's a mixed bag. Good news first. Aircraft fuel expenses actually decreased by 9.1% compared to last year.
Okay, that's a helpful tailwind. Fuel is a huge cost for airlines.
Massive. But other costs, everything except fuel, went up by 21.5%.
Ouch. 21.5% increase in non-fuel costs. That's substantial.
It is. So when you look at the overall cost per available seat kilometer, or CASK,
Yes.
it actually decreased by 6.8% down to INR 4.31.
Okay, so total cost per seat flown went down. That sounds good.
On the surface, yes. But remember that big drop in fuel cost.
Ah, right. So if you strip out the fuel impact, what does Carrick X fuel look like?
That's the crucial number for operational efficiency. And CASK ex-fuel actually increased by 2.5% to INR 2.93.
I see. So lower fuel prices mask a rise in their underlying operational costs per unit, like
Yes.
maintenance, staff, airport fees, that kind of thing.
Precisely. While they benefited from cheaper fuel, managing those other operational costs seems to be more of a challenge right now.
Okay, that's a really important nuance. Now, one area that often helps airlines is ancillary revenue bags, seats, food, all that. How did IndiGo do there?
That was a definite bright spot. Ancillary revenue jumped by 22.1% compared to last year.
22%. That's strong growth.
Yeah, it reached INR 21,534 million. It shows they're getting better at generating income beyond just the ticket price.
Does that kind of growth offset the pressures we saw on ticket revenue and the rising non-fuel costs? Is it enough?
It certainly helps cushion the blow, no doubt,
Yeah.
and it's a smart strategy to diversify. But, ticket revenue is still the core business. So
Yeah.
while ancillary growth is great and boosts resilience, it doesn't entirely solve the other pressures. It strengthens their position, definitely.
Got it. Okay, let's look at the overall balance sheet health. Cash and debt. How much cash did they have on hand at the end of June?
Their total cash balance was INR 494,057 million, almost half a trillion rupees.
That's a lot of cash. Is it all readily available?
Not quite all of it. It's broken down. Free cash, which they can use freely, was INR 348,019 million.
Okay, still substantial.
Yes. And then there was INR 146,038 million in restricted cash. That's typically earmarked for specific things like lease payments, security deposits, things like that.
Right. And on the other side of the ledger, debt.
Total debt stood at INR 684,884 million.
Whoa, okay, so more debt than total cash.
Yes. But it's important to understand what that debt is. A huge chunk of it, INR 467,818 million, is capitalized operating lease liability.
Meaning debt related to leasing their aircraft.
Exactly. It reflects the long-term commitments for their fleet under accounting standards.
So thinking about the bigger picture then, lots of cash gives flexibility, but that large debt, especially the lease part, represents significant future obligations. How does that balance out for them?
You've nailed it. That free cash provides a crucial buffer, essential in the airline business, which can be so volatile. It lets them react to issues or grab opportunities. But the high debt level, primarily those lease obligations, means a good portion of future earnings is already spoken for. It affects how much they can invest in big new projects without taking on even more debt or eating into that cash cushion. It's a constant balancing act.
Right. Speaking of volatility, the CEO mentioned those significant external challenges. Can we unpack what those were?
Sure, the press release mentioned a few specific things impacting the whole sector: geopolitical tensions.
Which often mean longer flight routes, more fuel burn.
Exactly. Also, airspace restrictions, which again impacts efficiency. And they also noted the impact of a tragic accident in the Indian aviation sector. The source doesn't give details on that specific accident, but clearly it had a ripple effect.
Yeah, those are big macro factors. What about things closer to their own operations? Any specific hurdles mentioned, like regulatory stuff?
Well, one ongoing challenge is foreign exchange, or Forex volatility.
Ah, yeah. Airlines deal a lot in dollars for planes, fuel, international routes.
Right. And for Q1, IndiGo reported a Forex loss of INR 1,473 million. So currency movements worked against them this quarter. It's a constant risk they have to manage.
Okay. Now, this next bit sounds really interesting. The legal and tax disputes. These can be quite significant for big companies. What's going on there? Let's start with the IGST issue.
Right, this is a big one. IGST is Integrated Goods and Services Tax. IndiGo has paid nearly INR 19,800 million. That's INR 19,782 million to be precise, under protest.
Paid under protest. For what?
For IGST levied on the reimport of aircraft parts after they've been sent abroad for repairs, basically taxing parts coming back into India after being fixed.
IndiGo thinks they shouldn't have to pay this.
Correct. And crucially, they've had some major court rulings go in their favor. The Supreme Court recently, July 14th, 2025, upheld a decision favorable to them, and the Delhi High Court back in March 2025 actually found this specific levy unconstitutional and invalid.
Wow. Okay. So the courts seem to be siding with IndiGo.
Largely, yes. IndiGo's position is firm. They believe this tax is not payable, and they're showing this amount as something they expect to get back.
So nearly 20 billion rupees potentially coming back to them, or at least not being a final cost. That's significant.
Hugely significant. But it's not the only tax issue. There's also an ongoing income tax assessment.
What's that about?
The tax authorities have reviewed IndiGo's returns up to assessment year 2022-23, and they've made adjustments disallowing certain expenses and, importantly, changing how manufacturer incentives are treated for tax purposes.
Manufacturer incentives?
Sure.
You mean like discounts or credits they get when buying planes and engines?
Exactly. The tax authority wants to treat these as taxable income. If that view holds, IndiGo estimates the potential tax hit could be around INR 24,185 million.
Another massive number. So almost 25 billion rupees at stake there. Where does that stand legally?
Similar story, actually. IndiGo has gotten favorable rulings on these issues from the Income Tax Appellate Tribunal, the ITA.
All right.
However, the tax department hasn't accepted that and has appealed to the Delhi High Court. Those appeals are still pending.
And IndiGo's position?
They believe, based on legal advice, that the ITAT's view supporting them is likely to be upheld by the higher courts. So, like with the IGST, they haven't made a provision for this potential cost in their accounts, as they expect to win.
Fascinating. So two major legal battles over taxes, with potentially billions of rupees hanging in the balance. But IndiGo seems confident based on initial rulings. This really highlights the complex environment they operate in.
It absolutely does. It's not just about flying planes, it's navigating complex regulations and legal challenges.
Okay. Switching gears slightly, any notable changes in the boardroom? Leadership shifts?
Yes. A few key changes. Mr. Michael G. Whitaker joined as an independent director from July 14th.
Okay.
And Dr. Venkateramani Sumantran finished his term as independent director and chairman on May 28th.
And who took over as chairman?
Mr. Vikram Singh Mehta was appointed chairman, also effective May 28th. And then just after the quarter ended, Mr. Amitabh Kant was appointed as an additional director, though that's pending the final security clearance from the Ministry of Civil Aviation.
So some fresh faces and a new chairman at the helm could signal shifts in strategy down the line.
Potentially, yes. Leadership changes are always worth watching.
All right, let's look forward. What did IndiGo say about the next quarter? Any guidance on capacity?
They did give some guidance for Q2 of this fiscal year, so the quarter ending September 2025. They expect capacity, measured in ASKs again, to increase by a mid to high single digit compared to the same quarter last year.
Mid to high single digit. So continued growth, but maybe a bit more moderate than the 16% we saw in Q1.
Seems like it, yes. A bit of a slower pace of expansion plan for Q2, but the CEO definitely reiterated their confidence in the overall growth of air travel in India and IndiGo's commitment to meeting that demand.
And finally, did they mention any awards or recognition recently? It's always nice to end on a positive note.
They did. They picked up several awards at the Buyout Pinnacle Awards from Bangalore Airport Network Airline of the Year for International Short Haul, and a special commendation. Plus, an award for their Diversity, Equity, and Inclusion program from the Bombay Chamber.
Okay, good to see that recognition. So let's try and tie this all together. We've seen IndiGo reporting a profit in Q1, which is positive, but it's down from last year despite revenue growth.
Right. Passenger numbers are up, capacity is up even more, leading to slightly lower load factors and significant drops in yield and RASK revenue per unit.
Costs were a mixed bag, helped by lower fuel, but hampered by rising non-fuel operational costs. Ancillary revenue provided a strong boost, though.
And their financial position shows plenty of cash, but also significant debt, mostly from leases. Operationally, they seem reliable, but they did shrink the passenger fleet slightly.
And hanging over all this are those really significant tax and legal disputes involving potentially huge sums, even though IndiGo seems confident about the outcome so far.
Which brings us to a final thought, maybe for you to ponder. When you consider these big legal battles over taxes alongside the moderated revenue environment and those rising non-fuel costs, what does it imply for how IndiGo might prioritize its resources and strategy moving forward?
Yeah, that's a great question. Are they going to be more cautious with spending or expansion until these legal issues are fully resolved? Or will they push ahead with growth relying on their cash reserves and confidence in winning those cases?
Exactly. It's not just about the numbers in this quarter's report, but about how these ongoing challenges might shape their long-term agility, their capital allocation, especially operating in such a complex regulatory world.
It really shows how much is going on beneath the surface of those financial statements. We hope this deep dive has helped you see some of those underlying dynamics and encourages you to keep exploring these kinds of reports. Thanks for joining us.